Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn.
Chicago wheat. I know I have said this before many times, but it is still important. You see, the break in early October last year below the August to October ascending wedge pattern was a seminal moment here. 18 weeks ago, I laid out two avenues of what I thought might be the possibilities here. The market chose the first avenue and moved lower. I said at the time, and I quote, "The straightforward move down with potential targets for the ascending wedge pattern. Thus, a primary target X on the downside was already achieved in the 860 area, whilst the secondary harder to reach target X1 is way down below in the 712 area," end of quote. Since then, prices dropped below all the moving averages and in early March achieved the harder to reach target of 712. As part of this process, we also saw prices move down below the March 2014 high at 724. This high was part of a congestion band, 725 to 721, which also has the October 2013 low at 721 within it. I said 5 weeks ago when looking further lower, and I quote, "Below this 725 to 721 zone, there appears to be no clear support until the January 2021 high at 693, end of quote. Well, prices finally punched down through the 721 level at the start of March. Thus, 7 weeks ago, I laid out two possible scenarios going forward, and I quote, "The primary focus is on what has developed from a bear channel into a descending, expanding wedge pattern, highlighted in bright green on my daily chart and originating from October last year. Currently, that's 673 to well off the bottom of my daily chart. The upper trend line here has had the added benefit of the short medium moving average entwined about it since late November last year," end of quote. As we entered February, the trend line and the short medium moving average, well, they parted ways. But both were still heading lower, this time also backed up by the declining medium moving average overhead, which is currently at 764, that had capped prices in February. It was at this time that a partial repair took place on the broken descending expanding wedge pattern, with prices dipping below the upper trend line. But it's been a controversial period. You see, the market is now wrestling with two key supports, one of which is unique. They had a gap from July 2021 between 657.5 to 659.5, which is still not been filled, and a little higher, the 50% absolute Fibonacci line at 682. This is why prices have once again exited and re-entered the descending expanding wedge pattern. I highlighted this 50% absolute Fibonacci line in my last commentary. Now, to be honest, I'm not happy about this wedge pattern, and I'm thinking about retiring it. I put forward the idea last time that we may have a possible November last year to date, possible bearish halfway hesitation. Again, I'm not wholly happy even with this pattern, but it is worth considering. Hence, if this turns out to be the case, then we could see a possible move down to target X in the 609 area, just around where the July 2021 low is. All I can say is watch and see. Chicago corn. For many weeks here, this chart had been a headache to me with so many things going on. However, 5 weeks ago, it all seemed to be settling into a pattern order. However, before I explore this, let's set out the key elements that have been impacting this market. Start with the impact of the long moving average, currently at 658. This has acted as a de facto bearish trend line. Then there's a July to October 2022 ascending wedge pattern. I personally found this to be the most elegant of all the elements. Mid-October, the market exited this pattern with a primary target in the 648 zone and a secondary much harder to reach target X1 in the 550 zone. In early December 2022, prices dropped down enough to reach the primary target, but hesitated through January this year, most of February, before turning lower, specifically when punching through the lower time, currently 690, which is highlighted in green, bright green, on the July to December 2022 bullish shift pitchfork. Now this segues nicely into something I wrote 5 weeks ago, and I quote, "And I come to the two key and recent elements of this market. The lower time of the July to December 2022 bullish shift pitchfork, which I've highlighted in bright green, and a neckline, currently 695, of the November 2022 to January reverse head and shoulders pattern. Now you can look at these two elements on their own, but I would urge you to look at them combined into a new pattern, an ascending wedge pattern. The elegance of this pattern is sublime, especially as it has been made from two separate patterns. Currently the pressure is for a break lower as the long moving average is squishing the market lower, but I will not set out any targets for this pattern until one or other trend line is broken, but I can give you an idea of the size of the moves likely. Thus for a confirmed break lower it would have a primary move of about 13 cents lower and a harder to reach secondary move of 42 cents lower. End of quote. 4 weeks ago we had that confirmed break lower, and this gave a primary target below of 661 and a harder to reach secondary target of 632. The same week as the break lower, the market reached the primary target, and the week after prices reached the secondary target. Now you may think, well, that was enough, but no. There has been further developments. 3 further developments, in fact. Firstly, and still undergoing finalization, is a possible dead cross of the medium moving average, currently at 658, down through the long moving average, currently also 658. Please note this is a lagging indicator. Secondly, we had over the turn of the month from February into March a possible bear flag with a potential target X in the 590 zone. Thirdly and finally, we have seen the market drop down to the next key support and get stuck there. Now for 2 weeks. It is the lower time, currently 611, of the September 2021 to July 2022 bullish shift pitchfork, which is highlighted in purple on my daily chart. This pitchfork had never previously been tested on the downside, but the middle time above, currently 751, managed to cap the market back in late September and October of last year. Hence it deserved some respect. Well, it has held up the market and stymied the opportunity to reach the bear flag target at 590 below. Enough that this week we may have a possible reactionary weekly key reversal up. Thus, if we close tonight either over 617 3/4 or under 617 1/4, yes, I know it is a narrow range, but that is what's been happening these past 2 weeks. Well, if we close either side of those numbers, well, then we'll be on. At the moment, as I say, we're looking for a weekly key reversal up. The question then arises, if we have a weekly key reversal up, how will the bearish pressure of the earlier bear flag deal with such an eventuality? Will it offer an immediate counter, a weekly counter perhaps, or will we have something else? This has all become very, very interesting.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.